Steve. And Steve emphasized 3 awesome panelists, no more than an hour and a half, so we have to make the most of this.
An hour.
All right.
Hour.
From far end, Mike Millett at Hudson. You know him. Likewise, Julia Henderson Vestu. Chris Caponegro, Axis. I'm Tom. Let's jump into this. We only have an hour.
Thank you.
First up, we're coming off, going on 6 years of heavy cat losses. Need for diversification has come up at every one of these panels for longer than I've been in the market. Mike can tell you exactly how long because he's been hearing it longer than anyone else. So this brings up the question of where do we go next? Where can we go next? Where should we go next? So I'll start with you, Mike. Where could the ILS market go next, either conceivably or sensibly?
Well, for starters, we could go a little bit back to the future. After 6 difficult years, we do have a bit of a capitulation that is finally driving some value back into certain parts of cat. And it's tricky because what we've lived with for the past 6 years is a steady competition between rate and loss trend, and rate was losing for the most part until this year because we took rate in 17 and 18 and 19 and 20, at every level, at homeowners, at cat reinsurance, and in retro. We were taking rate, and the combination of climate and loss trend consisting of economic inflation, social inflation, and I think some more insidious underlying slippage in policyholder behavior. All those things were more than keeping up. I think we might be clearing the treetops on that. So we can't get we can get too deep into this TOFL dynamic, too old for Leo. At 26 years old, the cat bond market may be there, but we have to look at the fact that actually in the cat bond market, in the upper stretches of the ILW and retro markets, rate to expected loss is as good as it has been. It's as good as it was in the sort of best months of 2006. And it's as good as it was, it was as good as it was when we were selling Res Re #1. So let's not forget that over the past 25 years, this has evolved, and it's been a useful source of diversification. And it's gone through a tricky adolescence, or I guess tweenerescence, because it's in its 20s, but we're getting through it. But now let's talk about other things. Because one of the glories of the insurance space is that it diversifies the broader capital markets. But a second glory of the insurance space is that there are all sorts of internal sectors that diversify each other. And we're seeing it now. I had a conversation with somebody, are we in the springtime of cyber? The sector that we are most interested in and have been for about a year and a half, and which has been producing very good risk return, is the broad life insurance space. And I don't just mean extreme mortality. I mean the broad life insurance space. There are interesting things to do in insurance debt. There are sectors of specialty that have hardened. So, we're back in 1997 in terms of risk return in cat. But we have a broader beachfront that is starting to actually produce deal flow. And I think that we should be embracing that.
Now, Julia, as I understand it, you're kind of living the future already as part of your strategy in terms of looking at some of these newer and non-cat classes of business. So based on this, based on what you've done, you've seen so far, what we've discussed, what do you think is or should be next? Or is the present for you, I guess?
Yeah, so it's interesting you talk about us at Vestu living the future. I'd say we're living the now, and insurance is finally catching up to the rest of what's happening now in terms of tech development with, and I'm going to use buzzwords that are way overused, like AI, machine learning, and things like that. However, one thing that we've done very poorly at, I think, in insurance, and specifically in the reinsurance space, I shouldn't speak for the entire P&C market, but what we've done poorly, I think, is utilize these technologies to allow investors to gain comfort with the asset class. I think we all agree here, I don't think anyone will find this controversial. The space, specifically reinsurance, is opaque. It's a liquid. There are features of this asset class that make it incredibly difficult for any investor, cat or not, to get comfort. In the cat space, we have some vendor models that have been well investigated, have big gaps. Still asking the question around climate change. I hear that all the time. I've been around the globe. I've talked to a lot of different people, investors, cedents across the board, and very glad not to be in the cat space for the first time in my career for the past 2 years, which is its own challenge, interestingly enough, but also extremely exciting. And one thing that we've learned is that the technologies we built over 4 years are resonating with these investors, that what we can do is provide a transparent, objective risk price in non-volatile lines for investors to gain comfort. And so that's I guess, the future, as you would ask. But I'd say it's more, the tech is now just being applied that's existed.
So before we go to you, Chris, I just want to follow up on something here. The use of vendor models and analytics is prepackaged and generally not a daily exercise in reinsurance. So before reinsurance, I did a lot of consulting in the retail space where analytical activity is a minute-by-minute exercise if you're slow.
Yep.
Do you see what you're doing as somewhere in the middle, and do you see the industry as a whole progressing from seasonal or deal-related to ongoing analytical commitment?
So I can't answer that for the cat space, and I won't even try. But what I can say is, because we own this technology, we use it, that it allows our investors to see the data as it comes in live. And there is no delay in kind of understanding NAV or claims. The delay happens, of course, in the chain, right? So as the claim gets made to the insurance company, to the reinsurance, there are delays there that we are attempting to shorten via other technologies and APIs and other work. But I don't think we get around that as easily as one would hope.
Chris, you're also living the post-cat world, I guess. What do you find attractive right now? What do you see as either today or soon to be tomorrow?
Yeah, so I'll speak to more of the soon to be tomorrow, partly today, and more broadly. So I think when we look at ILS and practitioners and what we bring to the overall insurance and reinsurance ecosystem is we bring private capital to the balance sheet underwriters. And principally, I think what we need to do is look at what lines of business will need capital. And rather than just trying to create activity with new capital that people may have raised from investors, just for the sake of generating AUM or activity or diversification, really fundamentally have to ask, why do I need this capital? And that why should be based on profitability, growth expectations of that asset class, and the sheer need to bring that capital in long term. And so right off the bat, property does answer, ask that question of, why, and it should be there, because with an inflationary time like right now, there's just not enough capital, nor will there be in the near future to be able to satisfy the growth of insured values, right? And then you look at the next asset class, Mike mentioned cyber, right? That has every potential to need more capital than any of the balance sheet companies or fund managers that are out there right there today to be able to satisfy the demand. Once that spigot opens, it's going to be bigger than property. And then you have to think, all right, what could be beyond that? And, I think in today's world, very few lines of business come to mind that will satisfy that other than the first two. But those first two are really good whys to be asking. And I think that's plenty for the next 5 to 10 years for us as practitioners to be able to tackle the interface to be able to bring investors into those asset classes as well.
Not plenty enough, because I have a request if you guys are taking them. I'm curious, and sorry, I didn't prep you guys for this one, but I'm curious to see about capital coming in to address basically the fiduciary and strategy risks associated with fossil fuels and not transitioning. Is there some sort of legacy or runoff play for professional liability in the fossil fuel space as the expectation of transition becomes more and more pronounced?
So what you're asking is there a capital markets bid for legacy liabilities associated with petroleum because the industry itself has their own ESG priorities in disposing of those?
Yes, if in 5 years you could be sued as shorthand for being a fossil fuel company, there is a massive need to think about,
Oh,
legacy
so your
loss
question is different. It's not an ESG question, it's
It,
a
well,
liability.
it is though, because the ESG commitment is part of the reason why these guys would have to transition. Their strategies would be seen as unacceptable, and thus they're open to class action, like shareholder class action lawsuits.
So, I mean, let's give that a solid maybe.
I'll take it.
Remember that there's about $100 billion of funds in the insurance-linked world, and this is not transparent, but I'm going to just estimate that 75 to 80 billion of those are pension funds, endowments that have their own ESG priorities as a general rule.
Yeah.
But those vary. So there are different states that actually have what I'll call a positive bias. There's toward petroleum.
Yeah.
So I don't know. Maybe somebody will construct a business model like that, but it is a tough one, because on the investor side, we have a little bit of a world of different camps growing up. There is the litigation side, which is a separate artifact, which hangs like a shadow over these. So it's interesting. And I'm not sure that there aren't, 7 opportunities in the insurance world that are sort of more interesting, more engaging risk-return opportunities for investors right now. But it is interesting, as always, Tom.
I'll take interesting, because we want to save the world a bit. And Mike, you bring up a good point, which, Chris, I'll turn to you, is, you think about, as you mentioned, demand for capital and protection. Mike, as you were walking toward, is investor demand for a certain type of opportunity. What sort of investor demand are you seeing right now? So what are investors asking for or asking you to explore?
I mean, without question, float, right? We just came off a period of 10, 12 years where it's been zero interest rates. And with interest rates rising, all of a sudden, every PE manager out there in the world is looking for ways to find, float, essentially, ways to partner with companies for float to be able to invest into other asset strategies. So that's certainly, arisen as like a top demand out there right now.
So more longer tail stuff?
Yeah, more longer tail. I think you're going to start seeing a lot more activity with legacy companies, and they're really well positioned right now, I think, to start partnering with a lot of firms to bring in more capital in that space.
Yeah, I mean, what we're hearing is yield enhancement, actually, about non-volatile yield enhancement. That,
Non-volatile.
again,
Yeah,
that is not correlated to the
property cat
capital
reserves.
markets.
Yeah,
Exactly.
it's
I think
longer
there's
tail.
structural elements that make this asset class, the non-cat, or I should say non-volatile specifically, more appealing because of capital trapping mechanisms that can be designed in a more effective manner, that can be more predictive, less, cat risk is great, sure, if you can model it, but it's not predictive. Whereas in the non-cat space, it's more predictable, more.
And much longer term gives
Exactly.
gives the holder of it a lot more time to invest in longer dated assets. Yep.
Yeah, I think broad-based investors are not having a wonderful time right now. Actually, last year was, if you run a 60% equity, 40% debt portfolio, last year was the worst year since the global financial crisis.
Jesus.
Because unusually, both of them performed poorly. Often you have one or the other. Yeah. Last year, both of them performed poorly. You have to go back to 08 was a little worse, but those are 2 of the worst years in the past century. It was a profoundly lousy year for long-term investors. So some of the priorities that flow from that include diversification, which has always been a draw to this sector. And length is a little bit more of a priority than it used to be, because there are many investors that are thinking, rates are high, it wouldn't be a terrible time to stretch out duration a bit. And so that affects different instruments that we're involved in the insurance space. That said, there's another factor at work.
Okay.
One of the moments of glory for our business was, the aftermath of Katrina. There was this huge capital destruction. The insurance industry was trying to put itself back together. And a good 25 billion from the capital markets came in, like 8 billion of sidecars, like 8 billion of cat bonds, participation in the new co-raises. And, part of what drove that cavalry wasn't that we were so compelling. It was that the global financial markets were in an absolute bubble. And people sensed it, that nothing was cheap in equities, nothing was cheap in debt markets. And that's not quite true right now.
Yeah.
I think that investors looking around, so we do need to compete. So their diversification, the potential for length are good. But we do need to compete more keenly with other sectors, because in 2005, 6, 7, the cat bond markets were coming off a very nice 10-year stretch of reasonable performance. And now we're coming off a 6-year stretch that is a little ragged. And the broad capital markets are serving up other opportunities. So, I think that ILS markets have qualities that investors desire, but we have to have some humility around it because it hasn't been a wonderful half-decade.
So an interesting kind of thought coming out of this is when we talk post-cat, and obviously we are once again in a post-cat year after Ian, you hear about rate hardening. And obviously there was a fair amount of that at 1/1. Cat was once again more attractive than it had been. Prices went up because there was a cat. Saw this, 5 years in a row. Over this period, one of the things I always found is that the biggest barrier to new lines and new markets is cat rate hardening. Do you get out of cat now that you're going to make the money back? Or do you take the higher rate online, as you should, and hope that 2023 isn't 2022? I'm curious your thoughts on this dynamic. Like, do you run into any headwinds or barriers or frustrations trying to divert interest or thinking from cat while the cat market rate is hardening?
I could maybe help out only because we don't do cat, so that makes our value proposition a little easier. I mean, I know you don't either as well anymore, so I'd be curious to hear your perspective on this. But I think there's actually, what I'm hearing from investors when I speak to them is just an actual loss of confidence in our ability to model this risk, full stop. I mean, I don't think that there is a climate change confidence at all. I mean, I think what you see is, over time you have purported experts and folks that can underwrite this risk. And I say purported because we say things like, in the cat space it was said, oh, we're great at this, we've been doing this 20 years, look at our results, it's amazing. Yeah. Okay, what about this wildfire? Was this in the models? No. Oh, no, yeah, but we got actuaries, we got great actuaries. They can tell you what your loss is, what your NAV would be after the event, right away. 4 years later, your capital's still dying on the vine. Yeah. So I think that's what I'm hearing from investors. I'd be curious to hear what you're hearing.
Yeah, I mean, it's been
from
a little while since I've spoken to investors about property specifically, but I just go back to like my old underwriting days, and there's nothing wrong fundamentally with property and different forms and fashions. You just have to price the risk right. And I think underwriters got very lax, and people got very lax in assessing the cost of goods sold going into that product, and it's been a really harsh reality on the catch-up. And you have to keep ahead of that. You have to keep ahead of that curve and keep aware of what's happening fundamentally with recent losses, et cetera, to be able to be on top of things. And also make sure when you're controlling the contract terms and conditions that they don't get squirrely, right? That's where everything goes haywire. And we saw a lot of that, and that's unfortunate. And so things just need to tighten up. People need to price the risk properly from the insured policy up, and keep those terms and conditions as tight as possible. And it could be a very viable asset class for investors long term. So
what I love is like when Tom serves up like a straw man
a meatball
that you're tempted to like deal with, but then you realize like it's a complete scarecrow. I've had precisely 0 discussions in the past year where I've said to an investor, like, there are really interesting things to do in the life and cyber sector, and they're like, oh, put that aside. I really want to talk about cat because rates are hardening right now.
This is not strong. I've run into this issue. I ran into it 17 trying to get people to trade some new stuff, and 18.
Yeah.
I mean, in the broader market.
17, 18, yes.
It's coming again.
17, 18, but 6 years in, no. A lot of investors, there's more the other way. There are more investors who have said that.
Exactly.
I'm not there right now. I do want to think about other things. So no, I think that actually cat hardening, what I call cat capitulation, which is we're finally repricing, and maybe even more important, reterming. I think like extension spreads are super important. I think named perils are super important. You know, so getting down and going all the way back down to the homeowners level, the sort of drift that we have from admitted to E&S business, all of that is really important. But investors are not pushing aside other opportunities because they only want to talk about cat. Investors have some bandwidth for cat because I think that there is a perception that there's some capitulation going on. But there's real engagement in other sectors. And other sectors have frankly been outperforming for years. Like we have been doing collateralized reinsurance in cyber since 2017. And actually over that period, that vector, which is smaller, has certainly outperformed cat.
Well, yeah.
We have been doing life insurance since 2016. That has way outperformed cat. So investors are actually interested in all of the above. They actually need to see a capitulation to be re-engaged in cat, I think. And they're seeing one, thank goodness.
What other barriers do you see in bringing new capital investors into some of these other classes of business? I mean, we always hear in the press and at these conferences that cat's been around for a while. It's maturely modeled. We've got $100 billion of ILS capital in this space. So there's this notion that getting either more of that pie into non-cat or bringing new capital in from non-cat almost implicitly winds up with a barrier in that it doesn't have the cat infrastructure that's already in place. What are you seeing there? What barriers do you see in matching capital to some of these non-cat classes of business?
I think one of the biggest things is the question of why would we do it this way? That's more, surely these balance sheets that are massive in insurance, Munich, these massive balance sheets, surely because these lines aren't necessarily capital consumptive. As cat would be, why would we do it this way? Why won't, I mean, what's the point? Surely you guys can't do it as good as Munich. Or there's this question around that, which is interesting. And I think it goes back to something you said earlier about capital relief, thinking about providing solutions that are more holistic, thinking about being more elegant in the structuring, and not being as sort of single line focused as some of the traditional players have been, and so discrete in their year. This risk is only a year, and it has to be like this. It has to look like this to fit in my little check the box.
Yeah.
And that's one of the biggest questions we have. What do you guys hear?
Yeah, I mean, basically, I think some of the key components are like when you look at like say cyber or any other line, it has to be like consistently profitable. There has to be margin in there for investors to make an adequate return against all the other backdrop assets, right? That has to be there. So that needs to be strong. And then on top of it, it's the interface, right? So how do you get capital into like say a balance sheet? Well, you have to have proper definitions for what is a loss, what is a trigger, and in some of these lines of business, it may be acceptable for a rated balance sheet to take some of these risks, arguably, but like really it needs to be further well defined, and a lot more work needs to go into those areas to make things nice, tight, with no basis risk. So when the capital comes in, you're not leaving one party with more exposure than they intended that's unpriced, right? So once you get that type of interface together, then it should burgeon, and you should see a bigger flow of capital coming into each of those lines of business that need it. And again, you need to have the why of, do I need capital for this line of business? Like arguably like something like marine, you don't need more capital coming in, like you don't. But like something like cyber, you will absolutely need that long term.
I think an interesting signal for some of these lines are the parametric solutions. What I mean by that is in CAT, you kind of revert back to parametric when things get too hard to place out on a UNL basis or an ultimate net loss basis.
So to clarify, by parametric, you're talking non-UNL, the broad
things that are
category
not,
of index. Yeah.
Right, not indemnity based, that are based on a price reporting agency. Right. And I think when—
Ideally PCS.
Well, this is about going to my question. I'm actually about to hit him with a question. Thank you for that, Mike.
He was fishing for it.
Don't-
That's
don't-
exactly
don't
where I'm
feed-
heading. Exactly.
Hey, Mike, don't feed the animals.
Well, this is about and I mean, what's interesting about what you guys do at PCS is I'll say purportedly, because I actually don't know how you do this, but I'll say purportedly provide an industry level view of the losses in catastrophe. I think what I haven't seen, at least I haven't seen in strength, is an ability to provide a price reporting sort of index for other lines. I know you do cyber and some other stuff, but
Yeah, so
I don't know the confidence level around that.
So there's actually been a lot more trading. We just aren't allowed to publicize it. So we've probably seen 600 or 700 million in marine and energy ILWs traded since 17, and that's just what I know about. So it could actually be a bit more than that. Our Japan methodology uses the same underlying approach that's in 5 cat bonds and has had $2+ billion of ILW limit against it. Terror, we've been used extensively, both US and worldwide. So there's a lot of use. The problem is outside of 144A format, you're paid to keep your mouth shut, not to celebrate it. And that gets tricky because you're building those confidence levels on a kind of retail basis. It's more what happens, in the boardroom or over coffee rather than with scale and with broad statement, which is difficult because if you want to build a market, you need a certain amount of mass activity to come with it. I can tell you, doing it one by one, makes your eyes look like this.
I'll give you big 3, which are modeling, tail, and tuition. I don't know if Karen Clark is here, but she is the St. Paul of our sector. She journeyed from place to place. Her offering circular disclosures were like the letters to the Thessalonians. And we had like all the apostles. We had Fuad Ben Dimarad and Paul Vandermark and Ming Lee and Ken Clark. In the early days, people forget in the first decade of CAT, the modelers were like kind of celebrities. Like they were the center of attention. We need that as we move into new sectors. And what I mean is investors, issuers, everyone needs to move around folks that are providing catalogs, benchmarks, algorithms to try to figure out whether they believe them and to start to position against them. Tail. One of the glories of CAT, less lately, but at least stuff winds up more quickly. Cyber is actually kind of lovely because 90% of it is claims made. So that helps cyber tail to be less than people think it might be. That is a little bit of an Achilles heel of marine. There is collateralized reinsurance of marine. We've been in marine markets for years, but it takes a while to wind up. So tail needs to be dealt with, and there are all sorts of ways to deal with it. When you do block of business deals, you're implicitly dealing with tail. And then the third is tuition. Heroes of the market. USAA paid tuition, meaning they paid to educate people. It was reverse tuition if you think about it. And they paid that over years and years. And what reward did they get? They placed like a $3 billion program, of which half of it is in the bond market, and they don't have to roll it every year, which seems like very gracious today. Aetna did the same thing. The first Vitality deal, people forget it, priced it over 600. And I told them before we did it, I said, you're going to pay up to do this, but you have to have vision. I do think that some of the cyber companies that are placing now understand that, and that's lovely. But you need folks that are saying, global premium was $9 billion last year, $25 billion in 2025, and what's their name? And the Chicago folks, William Blair says that it's going to be $400 million in 2035. I'm going to need a lot of capital markets capacity. If I pay 2.5 online more, it's not going to kill me. So those are the 3 that I would throw out.
Yeah, not so much, or not just tuition so much as buying your future growth.
Yeah.
And I would say at a bargain price, which kind of brings us to our next discussion as well. So, we started this with a discussion of what it takes to bring investors in. What about buyers? I mean, it's easy to say, here's a problem. Hey, investors, here's a lot of money. In cyber, we've seen people waiting on the sidelines for years, wanting to participate, and buyers saying, well, no, this is exactly the form we want, so forth and so on. So how do you get a buyer to move a little bit, at least, to meet the investor? Because at the end of the day, without both, you don't have a clearing price.
I'd say rating agencies and their influence, right? That generally drives a lot of capacity purchases for any rated balance sheet, I would say, right off the bat. And I think right now there's still a lot of work that S&P and AM Best are doing over emerging lines of business. So once they start solidifying, I think it's going to force the hand of many to have to look at bond, the cyber bonds and other things for cyber and other class of risk like that.
Terror as well, I imagine.
Terror, sure.
Yep. That's going to catch up with everybody one of these days.
One of these days, yep. Yep.
Julia, you bring buyers in.
So
this environment.
It's interesting because we've worked with good MGAs, and we've worked with very large.
We own some of them.
I know you do. With a very large continental European reinsurers and Lloyd's syndicates, and it's a wide, vast array of sophistication, history in buying, needs, and I think what's resonated with each and every one of these buyers is an ability to be fast. So where it might take an actuary many weeks, one actuary to figure out one single line of business, figure out a price, figure out a solution and structure, we can do it in 2 to 3 days. And in fact, I have my global heads of structuring in the room here, and they are amazing. And they use the technology in order to create these solutions very fast. We can also do multiple lines of business, so it's not so discrete for the buyer, so it can be a broader solution for these buyers. We can also think about things perhaps in longer terms rather than discrete years. And so that is where we've seen our solutions resonate deeply with buyers.
Is there a point, Mike, where it's too late? Where buyers take too long to meet in the middle, investors lose interest?
Well, we saw that in CAT. So mad hot summer of 1996. We actually had failed deal after failed deal. The CEA got bought out by Warren Buffett. And there was a reinsurer deal in Bermuda that came apart over indemnity issues. And residential re number 0 was pulled. So kind of no. It just, in a way, that was a testing time. So I think we've seen, actually cyber's off to a better start if you think about it.
It is.
We've seen a series of testing deals, much like COVR and AIG combined risks, over the past 4 or 5 years, and now we're starting to see deal flow, and it's interesting. We're seeing some indemnity deals. There's apparently an index deal coming. There's apparently a parametric deal coming. So a nice variety. That's a basis for a decent market. We have modelers. CyberCube is very active. There are other modelers. So it's off to a good start. I don't think that there's a too late concept.
What would you, in cyber, let's pick on cyber for a second, what would you tell buyers to help them close the gap?
What is your strategy? What is your strategy? USAA always knew, and I worked on 23 deals with them. Sadly, I couldn't anymore after I left. But when we talked to them in the mid-90s, they had a deep strategy, which is they wanted to be able to insure current and former members of the U.S. military wherever they decided to live and also provide a AAA level of protection. So they wanted that. And in order to do that, starting after Andrew, they perceived that they could not rely entirely on the traditional reinsurance market. So they set out to build state markets, they set out to build a capital markets, and they set out to deepen their non-traditional regular way reinsurance market commitments. And they carried all those operations forward for years and years, not because they were trying to save 15 bips on a cat bond, but because they wanted to provide the insurance that they provided because that was their strategy. Similarly, when Aetna merged with Coventry, they knew that they might overpay, but they pay properly for vitality bonds now. But they knew that they could become 30% more capital efficient by doing that. And we have one great cyber underwriter who is not, and that has just done a deal where I think that they have looked forward and seen the reinsurance market the way it is isn't necessarily going to support our rate of premium growth. So there are two spirits in which you approach the market. One is arbitrage. I can pay these guys less than I pay the reinsurers. But the market really gets going when people start to have strategic motivation.
I'd say articulation of that actually is important too, because you can have, I've seen strategies, but very poorly articulated that in fact, don't articulate the exact coverage, and that's where people get lost.
Yeah,
Hang
good
on,
companies are in the strategy business, not the arbitrage.
Exactly.
That's not a business.
Yeah.
What are your thoughts on story and strategy, Chris?
I mean, again, it goes back to the why, right? So the good strategy is clearly a good reason why to foster the growth of more capital coming into a line of business. And like again, if you look at cyber, I mean, you look at the players out there. We have at AXIS a fantastic franchise in cyber, but like there's only you can only grow it so much bigger without the assistance of others on a capital from a capital perspective, and that's going to hit walls for the industry very soon, right? I mean, if you look at the cusp of who's currently entertaining cyber, more and more companies are, but there's less and less capacity available to those out there in the market in the traditional sense. It has to go into the capital markets in in some other format. So that longer-term strategy of serving your clients, being experts in your field, if you want to maintain that and keep that up, you have to build your own way forward for capital.
So you've mentioned the models, all of you, a bit when it comes to cyber. And in general, that's often the first question you hear when it comes to bringing capital markets capacity into the market is maturity of the vendor models. Do you need the vendor model to get it done? Or is that a subset of the capital market play?
Less than it used to be, but yeah, to make it big. So less than it used to be. 25 years ago, there wasn't an installed base of $100 billion of insurance funds where on the margin portfolio managers were empowered to take insurance risks based on their own modeling or other actuarial modeling. So you can get things done without a modeling firm in a way that you couldn't in 1996 because there was no installed base of empowered investors. That said, it's a lot of fun to live in a world where I get to hear the same things, at 58 that I got to hear at like 28. Because, now people say, well, how can you possibly model cyber? Let me tell you what I used to hear about CAT. I mean, selling Res Re 1, part of my argument was we're spreading it like at a midpoint between Nigeria and Morocco because that was during this emerging markets bubble. And so I was like, if the risk analysis doesn't feel stronger for you than Nigeria and Morocco, then you shouldn't buy it. But that caught people. It took people a long time to develop faith. And then it was disappointed from time to time, and then we rebuild the models. But that's not just true here. That's true in residential mortgages. That's true in CLOs. That's true in every other part of the market. That we build models, and then they find defects, and we rebuild models. So I think that we can have a cyber market that's a couple billion of flow without significant modeling firm presence. I think that to have the sort of cyber market that is probably going to be needed based on rates of growth 5 years out, you're going to need modeling firms that people really think about the risk with.
More than one?
Usually
it's always nice to have a debate.
I think you also need losses. I mean, as bad as it sounds, to be able to judge the usefulness of the models. And the models that at least I've seen, and I won't name names, but it's easy to guess, is that the kind of vendor one that we have now has a lot of flex in it, almost too much. I know that that's true of CAT models as well, where you can turn dials up and down. I was a CAT modeler. That was my first job in the business 20 years ago. But this one is wild. It can have wildly different results. And I think that's where you start losing confidence in your ability to sell it to broader capital markets, because that conversation's always tough. Okay, how do you take your view? What's your view? Oh, no, on that one, we're down -10 there, but we're +10 here. And when you walk down that road with an investor, it ends up, you walk a wire on that one.
But modeling is something of a dialogue. One of the things is we're on a better base with cyber to start with. Like cyber, I don't think the industry has ever had, the industry as a whole, 100% loss ratios in cyber. Whereas that was a regular occurrence in the cat world before the capital markets existed. It was more frightening. The cyber market, after Target et al., after Target and Home Depot and JPM, after those, pricing went up, terms tightened, and then loss ratios went into the 40s, then they crept back into the 80s, and then everything hardened up and they went back down to like 55 or wherever they are. So, this is not high drama. This is, so people treat it as though, how can I possibly understand this vortex? But actually, the line of business is pretty tame, and there are reasons to believe it should be.
Yeah.
Cyber risks in some ways are more like outage than they are like cat. We may be using the wrong metaphor.
I'd agree.
That's fair.
We have to think about that.
Yeah.
Because, the physical damage is often limited and often excluded. So in many ways, the biggest thing we should think about in cyber is days of outage deductible, because that heals so many wounds. So it's interesting. Modeling is a dialogue, though. Like, we all remember, we had the modeling firms come out and talk about, is earthquake time-dependent or time-independent? We talked about the vectors of demand surge in hurricane modeling. I remember when AIR came out and had different angles of attack for, instead of just hurricanes hitting the coast the same way, they flexed their model. And we are flexing models now because it's clear that we're not capturing all the nuances of the layers of economic inflation, social inflation, and demand surge and the way that they interact. So modeling will be a dialogue in cyber as well. We have to get that going.
I like your thoughts on time-based deductibles as well. I mean, I've been doing some research on reversibility outside of insurance and comparing or contrasting cyber and kinetic warfare. And the one differentiator is it's easier to reverse the damage of cyber because you're rebuilding systems. Even if it is destroyed, you have a lever. Whereas with kinetic warfare, once something is blown up, it tends to stay that way until a whole lot of work is committed.
Or a hurricane.
Or a hurricane, for that matter.
Until you rebuild it.
Yeah, which takes a while, and now you're waiting on a scarcity of materials and labor, and you see the risk of inflation on those materials and labor. Not to say that there isn't a resource risk on cyber, but we all saw what happened in Houma, Louisiana, when you needed plywood and went to Home Depot. So we have 18 minutes left. I do want to talk a little bit more here, but that being said, I don't want to shortchange you guys. So from this point forward, if you got a question, raise a hand. We'll get you a mic. In between those questions, we'll keep talking. So get ready with questions now. But at this point, one of the questions I've got before they ask is, one of the things I've run into with clients a lot in the ILS space is whether they use existing funds or raise a new fund for emerging risks. What are your thoughts on this? Is it difficult to raise dedicated capital for some of these emerging risks? Do you think it should be split as existing? Give me your thoughts.
We were talking about this earlier.
Yeah.
Go ahead.
Chris?
Yeah, I mean, I think with, if you look at existing funds and putting new risks in it, it's always an easy conversation to talk about having like free leverage by adding that additional peril. But I mean, that only goes so far. So I think, like that's a stopgap measure, I think, for anyone that has like a balance sheet and lots of lines of business and people saying like, I want to add this line of business into the fund to add more return potentially, right? So I think it doesn't really do the proper service for a line of business that you really need to scale and grow. So I think you really need to look honestly at that and say, all right, we need to fast track a new capital source for that line of business and grow it independently of having it be just leverage within another fund. It is just the way I would prefer to handle that.
Both. I think that it depends on mandates. You either have a very open mandate, in which case you should be looking at a lot of risks. So we do some of both, and I think that is the right answer. I think that funds are in some cases designed too narrowly to begin with, and investors miss real opportunities. So mandates should generally be broader, and then sometimes, those investments outgrow what should be a side allocation in a larger fund, and they warrant their own. I think that's how those generally work.
I think it depends. I mean, I think what Mike said earlier about us getting compared to credit funds and other broader financial asset classes that are outperforming, 700 plus spreads. I mean, that's where the rub starts coming in. Cash is hard to come by. We're seeing it in the blow up and kind of the credit IP space, certainly as it's brought back into insurance, and how that form of debt is actually significantly cheaper, less dilutive, and others than equity capital. I mean, there's no question there. But people are paying 1,500 basis point spreads. I mean, it's a lot. And so that comparison is where I think the non-cat, specifically asset class, gets compared against. Mike already mentioned this, so I'm not going to repeat it. But I think it's actually fair. I've raised capital in cat markets, and this is one of the hardest cat markets since Andrew. I'm now raising capital for the non-cat market. It's significantly easier. And it's not easy. It's never easy.
Well,
I'm not
no.
saying that.
I mean, you're
raising
asking
capital
for,
is hard.
yeah, people to
but
part with significant
comparatively easier. I mean, we're getting through the door even as a newish company where we don't have 20 years of access and 30 years at Goldman.
21.
Sorry, thank you.
But
I'm not that old.
No.
But 30 plus years
But
of Mike.
we're at heart an Israeli tech company that was built now with insurance expertise, and we're getting asked into doors much more easily than when I remember sitting there raising kind of the first sidecar when I was at Ren. So it's an interesting experience.
Investors are looking for things that are working. There's a mix of things. There are things that are really working in the insurance world right now, and we should focus more on those.
Yeah.
Number one, life insurance is kind of working right now. Virtually all of them are trading at like 90% of their 52-week highs. Gently rising rates and sky-high spreads are amazing for life insurance companies, which depend on NIM. In the wake of COVID, life insurance sales are up. In the midst of financial turmoil, annuity sales are up. The whole life insurance sector is already well into springtime. That's working. The services sector is generally working. Premiums in most sectors are outgrowing inflation. They generally run 30% margins. Their expenses are increasing at inflation. Their premiums are actually 50% higher if you do the math, and they're increasing faster. So insurance services are generally doing well. Depends a little on their leverage, but that's engaging. Excess and surplus lines are doing well, and we saw like a wonderful IPO go off in there. So there's a lot that's working in the insurance world. And we should be trying to bring those diversifying values to investors as well. Investors are interested in those things. Mm-hmm. There are new funds being raised, and of course, cyber.
Yes. And what there aren't are questions, and we need to change that. Come on, Bueller. We got one up front. Someone get Ari a mic.
You don't need a mic, Ari.
Or put some bass in your voice. Thanks, Steve.
My question is, what archetypes of investors are more interested in investing in cyber? Like PE funds, hedge funds, or pensions? Do you see?
Well, if you look through the cat fund universe, I'm going to just knowing the 50 or so funds as I do, I think that their quantum is about 75 or 80% pensions, endowments, sovereign wealth, about 15% high net worth, and about 5% other. And those funds as a group are a proxy largely for pensions and endowments. Pensions and endowments clearly are somewhat interested, not necessarily buying, but interested in cyber risk, and there have been definitely direct sales of cyber risk into pension funds, either through collateralized reinsurance or through carriers. Don't forget that a lot of large pension funds actually own carriers. I think that the interest is a little experimental, a little guarded, but a little bit sincere because it's fairly urgent, especially after years where both debt and equity returns are negative for pension funds to think about diversifying risks.
I mean, you got Byron Trott coming in for what he did, so that kind of says a lot there.
Sure. Of course.
Next question. While someone thinks of something so we don't look bad, I'll ask. I'm hearing more and more about demand for political violence capacity. During the riots from 19 to 21, people were looking for terror cover because they couldn't get riot cover and figured they ought to buy something for something. Now, obviously, that's evolved with the full spectrum from, you've got strike, riot, civil commotion, non-SRCC PV, there's terror risk, there's the risk of war and warlike activity. I'm not going to call anything a war, nobody's got a definition. And when PCS calls it a war, it means something totally different. But when you look at armed conflict in its various forms, it's only becoming bigger. And my question is, as an industry, how are we going to adapt to this and provide capital? Because this is one of the major social problems, and insurance purports to have a social mission. What are your thoughts on marshaling capital for PV?
Well, it's tough. It hasn't been urgent yet because London feels like it has plenty of capital. So there haven't been lots of deals flowing out into the markets. But it's an issue. And it's a bigger issue, I think, than you say. Because, over the past 20 years, we've lived in a time of relative geopolitical peace. Really after 9/11, after the Berlin Wall fell, and even more after 9/11, because, 9/11 was certainly violent and stunning, it instituted a security regime that calmed things down afterwards. So there was war in the Middle East, but the rest of the world was not so engaged in that. The level of geopolitical instability is certainly higher. We have a large hot war going on in Russia and the Ukraine, which shows, which many fear will expand. We have tension in the Far East, which is probably as high as it has been in decades. We've had strikes, riots, and civil commotion occurring everywhere from Latin America to Iran to different parts of the rest of the world. We have a certain level of tension in the US and Western Europe. So I think that we're in a different risk regime relative to geopolitical uncertainty. I think that's a broad problem for London because strike, riot, terror, civil commotion, war, aviation are all interrelated perils that tend to trade there. And I'm not sure how to benchmark those risks, but the risk level, there's climate change, but there's change there. And the risk level today is a lot higher than the risk level 18 months ago.
And when you put climate change and geopolitical risk change together, there will be interplay.
They will conflate, yeah.
Yeah, you've got human migration, water security, food security. I mean, the world's going to get a lot uglier. But what I find interesting is like our informal estimates on the insured loss from Ukraine, call it 20 to 25 billion ex-Russian aviation right now. No small amount, not really a big cat. But when you think about that $25 billion industry loss as relatively high velocity capital, pre-negotiated, subject to some pretty clear terms and conditions, we can debate that, but compare it to 4 and 8 and it's clear and understandable. Insurance does a good job of sending capital to people who need it, kind of with expectation. So if that plays out in Ukraine the way it should, and $25 billion of capital flows into named parties to rebuild, what does that tell us about expanding PV coverage in an increasingly uncertain world? Yeah, there are risks, there are loss issues, we need to run a profit. We're in that business. But at the same time, this is a line of business with a purpose.
Well, I mean, it may finally drive a capitulation in aviation. Because that's what the whole thing is. Like you said, you say the loss is like 20 billion, but I think the industry is owned up to like 3 billion.
Well, so that's
$500
X aviation. We're carrying.
Oh, you're carrying 20 billion X aviation.
Yeah, 20 to 25 in Ukraine, kind of onshore property per risk, ports and terminals, other marine. Russian aviation, we're mostly hearing 9 to 12.
Yeah.
Except for the folks who are calling it 4 and under. Credibly, I'd say we're hearing 10 the most and the most frequently.
Yeah, geopolitical is the next 5 years. Just think of what will happen if tensions get more hot in the Far East. The insured losses.
But this actually brings up an interesting point because I think one of the best asset features that we have in this class is the fact that we're not correlated to the broader financial markets. The PV is clearly very correlated.
PV is more correlated.
So that's where we run into, first of all, there's modeling issues alone. Let's just put that to one side. Our friends at Lloyd's have a good cover on that. But I think it's the correlation issue, certainly from the perspective of raising external capital to support this.
But there's no outreach yet, Tom, or at least not much that I've seen where the traditional markets are reaching out urgently for SRCC, PV.
That's true.
You know, and it may be that if this continues that that'll start to happen.
It's interesting because I'm hearing a lot of urgency. I think it's not getting to you yet because either A, they want to stand firm on, cede and advantage terms, which means they're not going to get out of bed if they can't get, seamless, non-basis risk cover. The other part is a lot of them have written the business too cheaply.
Yeah.
So if they're going to write it, they'll either invade margin or worse, like take the underlying business into a loss just by buying protection, which is, I guess, Mike, you say it was worse than I positioned it. I think it's even worse than that.
Yeah.
Everyone likes a little doom and gloom to end a panel.
I'm awesome at parties.
Great.
Seriously.
Great ending.
It's a wonderful time in the life insurance sector.
Let's go with life.
Yeah.
Let's go with life.
All right, we got like 3 minutes left. Come on, one more question. John, not even you?
Yeah.
Man.
Where's Perez?
That
There he
hurts.
is. Perez, get off your phone.
Oh,
You got a
yeah,
question.
come on, Andre. Nothing? Wow, you guys are dull, let's call it. Chris, Julia, Mike, thank you very much.
Thank you.
Appreciate it as always.
Thank you, Tom.
Thanks.